Good evening, everyone. Thanks for showing up tonight. I am Debbie Schwartz, founder of Road to College and the Paying for College 101 Facebook group. And I am here tonight with Jeff Bentley from Citizens. And I'll give Jeff a second to introduce himself in a minute. Tonight, we're going to talk about federal loans, both for your student and the Parent Plus loans. We're going to talk about private loans. And of course, we're going to talk about all the changes that are happening to the federal loans, and particularly the Parent Plus loans and the graduate school loans. And it's all going into effect on July 1st. So it's important information for people and families to understand this time of year. We have actually, Jeff has a presentation with lots of information. In addition, there are other people from Citizens here that are going to be able to answer questions. So feel free to put questions in the chat or in the Q&A. Either place is perfectly fine. We'll be looking in both places. And we'll also, in addition to answering the questions, if there's a question that we think more people should hear and discuss, we will bring it up in front of everyone. This is recorded, so you will get a link to the recording, hopefully in a few days after this session. And feel free to ask questions. There's a lot of people here to help answer. A lot of changes happening, this year more than ever related to loans. So hopefully the presentation and the information we're going to share tonight will really help. So with that, Jeff, I'm going to pass it to you.
All right. Thanks, Debbie. Appreciate it as always. Thanks again for having us. For those that attended my session last week with Debbie on smart financing strategies for college, you get to see my mug again for another night, except I don't have my co-host with me, Gina. But Jess and Crystal are here as Debbie mentioned, to answer the chat as questions come in. But again, we'll look and we'll see. And look and I'll ask questions, answer questions out loud as well as we see them come through, or they'll interrupt me and we can answer those as well. But again, thank you for joining tonight. We're basically going to be discussing federal and private student loans. Basically, what does you as families need to know? As I'm sure as you've seen in the news, there's all sorts of upcoming changes to the loan programs. So for those especially new borrowers that are going to school this fall, all that exciting things are going to happen. I'm with you in that boat. As on a personal note, I am the father of three. My oldest is a sophomore at Ithaca College in New York. I'm based here in the Northeast in New England. And so she's home for the summer now. And then my son is a graduating high school senior who will be attending UMass Lowell in the fall, doing some engineering there. So again, I'm living this. I really like to, in addition, so I'm sharing myself, and as Debbie just put in the chat, feel free to state where if you're on as a student, where you're going, or if you're as a parent, where your children may be going this fall, or what year you are, in either high school or graduated on the way to college. We're always, we love to know what part of the country you're from, where your students are going to school, et cetera. So please drop that in there. But yeah, so that's basically what we're going to be talking about today. Again, from personal experience, I've gone through this, and we'll be going through it again for my son this fall. All right, so tonight we're going to be just go over some basics on the cost of college, around so sort of level set around student loans as well. We're going to go into a deeper breakdown on federal loans as well as private loans. And then we're going to touch a little base on refinancing and consolidation, just for things you want to think about in the future. It may not be where you're at right now or where your students are at right now in the college process, but just want to at least address that. And then some pros and cons and smart borrowing tips, et cetera, around that. So again, I want to level set a little bit and just go into what are you going to be looking at and what you're planning for, let's say you have a graduating senior like myself and going into college this fall, what I'm going to be looking at as far as cost of attendance. So cost of attendance is broken out really in two categories: direct costs and indirect costs. Now, direct costs are the basics things that a school is going to charge you on the bill, which is the tuition and fees, the housing and food, formerly known as room and board, and health insurance, which again, health insurance can be waivable. That is something that, if you have health insurance yourself as a family, it will show up on your bill. But if you provide, basically proof that you have it, that'll be waived off the bill. But they do have to charge for it because students are required to have it. Now, where it comes into play is these indirect costs. So When you get a bill, you'll see the direct costs. Indirect costs are things your student or you may need to have them go to school. And those are things like books, supplies. Let's say, I live in the Northeast and my daughter is taking a bus to Ithaca. So I could put into her budget the cost of bus fare back and forth. Or if you're going across country, airfare, things like that. Transportation does factor in what's called into those indirect costs. My daughter will be studying abroad next June. So we can ask to increase this, the school can ask to increase, we can ask the school to increase the budget to cover those study abroad costs, the cost of the airplane ticket, et cetera. Um, as long as it's education related, they can be added to those indirect costs. Now, basically, what that means is that I can now borrow up to that new cost of attendance or whatever that cost of attendance may be to cover those costs if I can't pay for them outright today. So that's basically what it is. It builds a budget. Every student has a budget based on their major, based on where they're living, on campus, off campus, et cetera. Schools will assign that budget to that student. If you need more, great. If you don't need as much, you don't have to use what they've offered you in the budget, but it does allow you to essentially borrow up to that amount to pay for college and all the extra expenses that it takes.
Jeff, can I ask a quick question
Yeah,
about the cost of attendance? When
sure.
when do colleges generally release like cost of attendance for like the next academic year? So for it would be for the I guess 2026 2027 academic year.
Yeah, so for the upcoming year this fall, they should have already released that, of course, usually around application time. Schools use what's called a net price calculator to display what your likely aid offer may be. And that amount's going to be there as well of what the tuition. But usually, and it depends on the school. So a private institution will set that cost much earlier because they have the ability to do so. A lot of state institutions won't yet because it's reliant on state budgets and they may not, the trustees and boards and things like that may not approve tuition, whether it's an increase or what the increase may or may not be. But generally, families should know in the early, probably, and Crystal, correct me if I'm wrong here, but it's probably in the late fall, depending on some schools, probably in the early winter is when students are applying for that early decision, early action, and regular decision. That's when those tuition and fees generally are released for the upcoming year. And again, that cost of attendance, it varies by student. So the direct costs you'll see on there, the tuition, the housing, the food, but that cost of attendance, they'll likely build in for, if you say you're in a particular major, they'll know that you'll need lab fees for, if you're taking biology or something like that. They'll be able to build in those. So you'll be able to sort of get a sense of what the overall school may cost. And again, it may not cost you that if you don't need any of these things, but if you do, they just want to make sure they build that into the budget. All right, so understanding a college bill. So again, real life bill here. This is my daughter's bill from freshman year. And so this is what a bill is going to look like. So for those going to school this fall, they should be released around now. A lot of schools do release their bills June 1. Some wait till July 1st, and they usually give you a month to pay them, or at least have an idea of how you're going to pay them. So right now is the time you want to be looking, depending if you get a bill. So basically looking at this bill as you see here, she was charged for a double room residence, a meal plan, the health insurance, as I said, which we ended up waiving, her undergraduate tuition, orientation fee. And so now we see that balance is $36,067. Now, she did get some grants taken off of that. So a campus visit grant, that's a one-time grant of $1,000. Now, note that you see here, this bill is per semester. Colleges always bill by semester. So this is her fall semester bill. And so she received a campus visit grant. We visited campus. We got $1,000. That's a one-time grant. That won't be reoccurring. So I do have to factor that in following years. She got a leadership award, which is great. Something she applied for on top of the college scholarship that she got of $14,000. And then she has a residential experience scholarship. So right now she does live on campus. If she decides to move off, that $2,000 goes away because she's no longer living on campus. So these are just awards and offers and things that the school provides that you want to make sure that either they last for those 4 years or there's caveats involved as far as GPA. You just want to make sure that when you're planning for sort of the 4 years of school, that and you maximize the free money, which is what we want to do. So I'm looking at this and I'm seeing that I have a bill of $17,000 for that fall semester, obviously minus the health insurance of $1,200. So looking at about a 15.5 or 15.7 balance for the fall. And so that's going to be what I need to owe. So this is before any sort of loans that we're going to take out. So that's where we're going to step in and discuss now going forward. This is kind of the gap that folks are looking at. How do I pay that? All right, so looking at how families pay for college, really four buckets here. Savings, which can be personal savings, can be a college savings plan like a 529 plan. Financial aid, of course, that's the financial aid offer that you just saw there with those amounts taken off, not including some of the federal aid she was eligible for, like loans. Present income, which is using the income you currently have, and I'm a big proponent of that if you have it to help pay for school. And then the last, of course, being student loans, which we're going to go over the majority of this presentation about. So before I jump into loans, I did want to talk about payment plans. I think this is a very important part of a college financing opportunity. And so again, personal example myself, when my daughter went to school, I bought a car 3 years before she went to school. And so I had a car payment every month that came out of my account. And so I had budgeted that for the last 3 years. The car payment ended up being paid off in full by the time the September of her freshman year of college. So what I decided to do was like, well, that money's already been out of my account for 3 years. I'm just going to take that same amount I paid for my car payment and utilize it towards college. And so that money's already been out. I set up a payment plan with a school. It wasn't 7,000. It wasn't 17,000 as you saw my bill. It was what I could afford. So let's say it was $4,000 or $5,000 out of my present income that I could afford each semester. And so I put that towards her bill. And so that allowed me to not pay interest on a loan. That allowed me to use my current income without really affecting my budget because it was already gone, and really helped stave off some of the overall cost. Did I end up borrowing? Sure. But it allowed me to borrow less and pay less interest because I was able to use my present income. So I always say if you have the ability to do that, and it doesn't have to be the whole amount, it can be a portion of it. Every school offers a tuition payment plan. It's usually a short installments, whether it's by semester or overall for the year. There is usually an enrollment fee. I think mine was like $35 or $70, whatever it may be. And then it'll, again, allows you to use present income to pay down the college bill without having to borrow for it. So again, I always encourage, if you have the ability to do so, to at least start with this and see what you can chip away at the overall bill using a tuition payment plan. But now we come to the fun part about loans, because college is expensive and it's likely that loans are going to have to be borrowed. Um, Basically, student loans are out there, and they basically help cover the cost of education. As I said, that cost of attendance, like the tuition, books, living expenses, etc. There's two basically types of loans: federal loans, which we're going to take a deep dive into, which are funded by the government, and private loans, which are funded by financial institutions like banks, like Citizens, and credit unions, state nonprofits, etc., other financial entities that offer private loans. Generally, who can borrow? It's a mix. A lot of times, federal loans or private loans are popular because students can be the borrower with a cosigner. Federal loans are student borrowers, also have parent borrowers. Private loans have a parent or slash sponsor that can borrow. So there's really is a mixture between the two loan types, both federal and private, of who can be the primary borrower. And then, as you understand here, repayment requirements, loans must be repaid with interest after graduation or separating from school. Again, scholarships, grants, free money, we want to maximize those, but loans do have to be repaid, and they do accrue interest over time. Looking at a couple questions here in the chat before I move forward. I would like to better understand how to set up a tuition payment plan. Just reach out to your school. Either it's through the financial aid office or the business office. We'll have the instructions on how to set up a tuition payment plan. And again, it's usually they all usually go through a third party service, through a private company, and you basically provide your information, your bank account information, how much you want to withdraw each month, and then that occurs that way. It's very seamless. It's a pretty seamless activity that you can set up with the school, and it's just a great way to start before borrowing. It's like having an in-school loan without interest, essentially, that you're paying off in full. So again, I always recommend it if you can. I see here what's the maximum you can borrow from federal loans. We're going to get into that upcoming. So let's jump into the federal loan program. So to answer that question that just got put in there, basically for federal loan programs, there's two types. So on your financial aid offer, it likely had one or both of these loans. They are offered by filling out the FAFSA. So if you filled out the FAFSA at your school, the free application for federal student aid, which you can still fill out if you're going to school this fall, you can still fill it out all the way till next June if you want to be eligible for one of these loans. And what the FAFSA provides is your student aid index score, and then you're able to see if you're what type of loan you're eligible for. Everyone is eligible for an unsubsidized loan, regardless of how much money you make or how little money you make. Everyone is eligible for an unsubsidized loan. The subsidized loan is where it is need-based. So if there's more need that you're having as a family, the subsidized loan will be what's offered to you. And the difference between the two, the subsidized loan, the federal government pays the interest while the student is in school. And until they also have a 6-month grace period after that loan when they graduate, and then they start paying it back. But it's basically a non-interest loan that the government is paying while they're in school. Unsubsidized, that means that the student is responsible for paying the interest on that particular loan, and it is accruing all during school. Okay, so for a first-year student, the maximum amount they're eligible for is $5,500. And of which you see on the slide here, 3,500 of that can be subsidized. So basically, if you took out the full 5,500 and you had met full need or had full need, then you would be eligible for that 3,500 and subsidized that the government is paying the interest on. But you would have a $2,000 unsubsidized loan that the student is now responsible for that interest. The loan amounts do increase slightly year over year. So a second-year student is now eligible for $6,500, a third and fourth-year student, $7,500. With an aggregate total of $31,000. So $31,000 in undergraduate student borrowing is the maximum a student can take out. Now you might look and be like, wow, 31,000 isn't a lot. You'd probably be right. That covers 1 year for some schools, let alone 4 or 5. Now you see also that 23,000 of that can be subsidized. So, and it could be a mixture. You may have looked at your financial aid offer and it could have been 2,000 in a subsidized loan and 3,500 in an unsubsidized loan. It all depends on what the need is, determines on how much you're eligible for on that subsidized amount. But again, that pro tip I see here, if you have the ability to do so, please pay the interest while you're in school. Interest gathers and capitalizes constantly on these federal loans. So you start with a $5,500 loan, and then by the time you graduate, it could be $7,200. So you want to make sure that you're able to pay the interest if possible. Quarterly, monthly, whatever you go. If you set up an account on studentaid.gov, you can go in, pay down the interest. So when you leave school, a student is leaving with a $5,500 loan, one that hasn't capitalized interest on top of interest, so on and so forth, that has just grown. Again, you're not paying the loan back. You're not starting repayment, but it allows you to mitigate the overall cost of the loan by paying the interest while you're in school. So always
Jeff,
recommend that if you have the ability to do so. Yes,
do you
Debbie.
mind, do you mind, I know you're using the word capitalized, but maybe just explain it a little bit more because I think a lot of people just may not know exactly what that
Sure.
means.
Yeah, exactly. So how capitalization works on interest. So essentially you start out with that at first semester, you get a loan for $2,750. So $2,750. The federal government does take a 1% fee off that loan. So you get a little bit less. So 2,600 and something, let's say, and you get that loan. And now immediately upon disbursement, so that's when interest accrues on all loans is when it disperses to the school. So while the student was awarded $5,500, only $2,750 is being sent to the school for one semester. And that's all the interest that's accruing is only on that one loan. The other $2,750 will arrive in January when the student starts their second semester. So it's immediately upon disbursement to the school, it starts accruing interest. So let's say after a month, the loan now isn't 26.25, let's say after, again, I'm not sure the exact amount after that origination fee. Let's say 26.50. So so you have 26.50 dispersed to the school. After a month, the loan is now 26.78. And then after that, the interest is now charged not on that 26.50, but on the 26.78. So now the interest a month later is not 26.78, it's 26.98. And then it goes up even more. And then the third month after that, now the interest is 3,100 or 3,150, whatever it may be. So
Right.
the new interest is now capitalizing on the new amount that had the new interest added to it. So that's just something to be aware of. So by paying the interest, you're actually just keeping that loan at that $5,500 throughout the time they're in school. And then they're, chipping away at the interest. So it's not capitalizing on top of each other. So hopefully that explained it, Debbie. I know it's
Yeah, I just wanted to emphasize that because that's why
sure.
it's so important if people can just, at a minimum, pay the interest while the students are in school.
Absolutely. It's definitely the way to go. All right, so how to apply for federal loans. Basically what we want to do is file the FAFSA, as I mentioned. That's the easiest way to get a federal loan. It's the only way to get a federal loan, to file the FAFSA. And then you review that financial aid offer you get, and then you can accept this loans through the school portal. After you accept the loans, there's other two steps you have to take. One is signing your master promissory note. So that promissory note, once a student signs it, not the parent, please don't sign it as a parent. It is a student loan. We have plenty of cases where the student doesn't sign it, and then 4 years later they go, I didn't take out a loan. It's like, well, you did because you signed the promissory note. I didn't sign that. It's like, well, maybe you didn't because the parent did. Make sure the student is aware this is their loan, their debt, not you as the parent. So the student signs the promissory note, and that's good for the time that they're in school. They don't have to sign it again their sophomore, junior year. They sign it once, and it's good for them to borrow the federal loans all the way through college. Um, Entrance counseling. So that is required. So it's required by the federal government for a student to complete entrance counseling. Basically, what it is I understand I'm taking this loan. Here's what a loan is. Here's the interest rate. Here's all those things. It's basically getting them to check some boxes, answer some questions, and understand that they are taking out a loan. Again, do they remember that a month after they've done it? Probably not. They will be taking exit counseling when they leave school to hopefully get a better understanding of the debt that they took on. But those are the two requirements for them to receive the funds from the school. If they don't sign the promissory note or do the entrance counseling or file the FAFSA, that's really the first and most important step. They will not get a federal student loan in their name. And again, you can choose to accept the subsidized portion and not the unsubsidized. If you decide that you don't want the unsubsidized portion, that's absolutely entirely up to you. That is one that's it's not necessary. If you decide you want to, I'll take the interest-free loan, but I don't want to pay the interest on the other one, sure. If you have other means to pay for college and you decide not to take the federal loans. All right, so some federal student loan eligibility. So basically, so you must be a citizen or eligible non-citizen. You must be enrolled at least half time. So that's to be eligible for any federal loan program, you must be enrolled, at least student must be enrolled half time. Meet satisfactory academic progress. That's going to be something the student's going to be aware of in school called SAP. Every school has a different threshold. Usually it's around 2.0, maybe 1.8, whatever it is. You have to basically maintain, somewhat of good grades in which to be eligible for aid. And you must all, of course, not be in default on any federal loans already. So if you had loans before and you decide to go back to school, make sure that those aren't in default for any loans you may have done prior. Federal loans are borrowed annually, so they don't carry over year to year. So if you decide that you got a lot of scholarship money and you don't want to take out loans your freshman year, you can't carry those freshman loans over to sophomore year and take that 5,500. Once that academic year is over, that ability to take out those loans is gone. So you'll be able to take out loans the following year, not a problem. You fill out a FAFSA, you'll be able to take out that $6,500 your sophomore year, but that $5,500 is gone. So it does not carry over year to year. But if you chose to take it, you can also return it. If you decide, let's say you get a big student gets a big scholarship and decides to return the funds, you can absolutely do that within the academic year. But at the end of the day, it's not something you can carry over annually. You either take it during that year or you essentially lose it. I saw someone put an interest rate question. Yes, so interest rates went up slightly. They were 6.47, I believe, this year currently. And then as of July 1st, 6.52 will be the current interest rates for federal student loans, undergraduate student loans, going forward starting July 1. All right, so plus loans. So the next iteration of federal loans is basically a parent loan. So as I mentioned, those undergraduate and student loans are in the student name only. That's their loan, not a parent loan, nothing else. The other federal loan that families can take to pay the bill is what's called the Federal Direct Plus Loan. It is an acronym, parent loan for undergraduate students. But they've also been segmented out now into Parent Plus and GradPlus. Basically, they take the same program for graduate students and same program for parents. So they've kind of used it for both. It is a loan that is, again, only in the parent's name. Student has no obligation to this loan whatsoever. Plenty of families make the arrangement that, look, I'll take this loan out for you. Handshake agreement, you'll help me pay it back. Certainly, that's the case. If you work that out with your child, that would be phenomenal, but they don't have to. They could tell you to go pound sand because it's not their loan. So just be aware of that. It's a loan in the parent name only. It is an easy loan to get. Thankfully, not a lot of schools put it on their offer letters now, but a lot of schools used to. So if you looked at an offer letter and your balance was zero, or your bill was zero, it's a lot of times because the school put a plus loan on there. And because all you have to do is really click, it's a very minimal credit check. You really have to have adverse credit not check not to get a plus loan. Again, it's a pretty easy process applying through the federal website to get the loan. And boom, you get the money that you need to pay for school. The caveats you want to look at, of course, is the interest rate. So the interest rate has gone up as it was this past year, 894, I believe it was. Now it's 9.07 starting this July 1st, which is close to the maximum that the loan is allowed to be. There is also a pretty onerous origination fee. So as you saw on the undergraduate student loans, I mentioned it was about 1%. For plus loans, it's 4.228%. So that means if you borrow a $15,000 loan, you have to borrow 15,500 and some others to cover that fee. And that's a one-time fee that comes off the top. And it is annual. So if you take out a plus loan your sophomore year, it's another fee. So just be aware that the feds do take a cut of that loan prior to it dispersing to the school. And so again, this can be the plus loans, basically you can pay these loans back while you're in school, but you can also defer them while a student is attending as well. So if you can put that into full deferment like a student loan where you don't have to make any payments, you can do the interest if you like to as well as a parent. But again, it's a loan where it has limited federal protections, especially going forward. So again, it's an option. We like to share that it is an option, but you may explore other areas as well before going into plus loan. All right, so now we're looking at changes. So for new borrowers this fall, Plus used to be able to have no limit on borrowing. So if your bill was $40,000, you could borrow a $40,000 plus loan to pay for your child's education. Done. And then continue to borrow. You could borrow 40,000 the following year, 50,000 the year after that, and borrow as much as you needed to send your child to school. Now, sometime, and again, you could do that without any proof of income or means to pay it back. So again, that you could see why that would be a problem. So, I think what this administration tried to do, maybe a little too far to one side versus the other, is basically try to put limits on that. And as you see now, Parent Plus loans have a limit. So whereas before you could borrow as much as you needed to pay for the education, now there's an annual cap per student of $20,000. So if you look and you owe 30 and you need to take a plus loan is only going to cover $20,000 of that 30,000 you owe. And if you look at what the aggregate limit is, and I like to say this, of course, that $20,000 times 4 is not $65,000. So as you see, if you're looking for a traditional 4-year degree, $20,000 a year does not add up to 65. But that is the new aggregate limit for each student that a parent can borrow on behalf of. Okay. There are 2 new repayment plans coming for new borrowers as well, new loans. And there's one called a standard plan and a RAP, repayment assistance plan. The repayment assistance plan is a new income-based plan. Current plus loan borrowers were eligible for income-based repayment, where they could be paying very minimal amount each month based on the amount that they owed. Plus loans are now only eligible for the standard repayment plan, which is a new plan that's based on the number of years to pay it back based on the amount that you owe. So again, changes afoot are happening with this Plus program, pretty major changes, in fact, for those that were relying on it. If in fact a parent is denied a Parent Plus loan, there are options. So a parent could get a cosigner, basically we call that an endorser, and try to get approved for that loan. They can file an appeal, of course, but the most popular option tends to be that the student is now eligible for an additional unsubsidized loan of $4,000 for a first and second year student and $5,000 for third and fourth year student. So while it does bridge some gaps, I mean, I worked at a school, I've seen that, and a parent gets denied a plus and they owe $12,000. And it's like, okay, you got denied the $12,000, we can give the student 4, but you're still going to owe 8. So that's where some of that issue comes in, even with the additional unsubsidized loan that a student may need. Because usually when a family is borrowing for a plus, it's more than $4,000 or $5,000. So it doesn't cover that full gap that the student probably needs to pay the bill. All right, wanted to go into for students that are looking at graduate school and beyond. There are some changes upcoming with that as well. So for graduate students, they had the ability to borrow direct unsubsidized loans. So similar to those unsubsidized loans that you had for undergraduate, graduate students cannot borrow subsidized loans. Those don't exist for graduate students, but they do have those interest-bearing unsubsidized loans. The current state of loans today is 20,500 with an aggregate limit of 138.5, which does include all their aggregate loans. Change is coming July 1st. There's no longer that 138.5 aggregate limit. They now have a $100,000 aggregate limit, not including undergraduate loans. So the cost of a program, if your grad program is less than 20,500 a year, great. The student should be able to fit within that limit. If their program they're going to, let's say, a higher degree, a higher cost program like an MBA, maybe that's costs more than 20,500, they won't be able to borrow above that amount. Current students could have borrowed what's called a GradPlus, as I mentioned that earlier, very similar to the Parent Plus program, which was basically they could borrow whatever they needed to pay for college, for graduate education, 40, 50, 60,000, $100,000, whatever it was, they could borrow that to pay for their graduate education. That loan is being eliminated as of July 1st. So if you have a student who's currently in school or looking at graduate school, you really should start planning now as to how that student is going to be paying for a higher cost program in graduate school, if that's the path that they're going down. We'll talk about private loans. There's work with a school that maybe has a little bit lower cost for the program that they're in, fit it within the 20,500 potentially as well. But these are things that are just going to have to be factored in for families and for students that are looking to go to graduate school beyond their undergraduate degree. Now that's for traditional graduate students. Federal direct loan borrowers for professional students. So these are your students that are in these potentially higher cost programs. Again, the same current state was at 20,005 with a 138.5 aggregate limit, but they also had the Grad Plus, again, to borrow up to that cost of attendance. So for professional students, they've now don't have an aggregate limit of $200,000, but a $50,000 annual limit. So not the 20,500, they're able to borrow up to 50,000, but only 200,000 overall. And now with the new lifetime limit of 257.5 for that lifetime borrowing limit. With Grad Plus being eliminated, again, these higher cost programs, it's going to be a struggle for some students to pay for them and figure out how to pay for them. The list of those programs you see are below. These are, it's basically based on an archaic financial aid called SIP codes, and these were the considered quote unquote professional. That's why you see theology in there and chiropractic. They did add one recently through what you call negotiated rulemaking. They added clinical psychology. Clinical client counseling and applied psychology. That was mainly done. The VA really pushed for that because of the lack of mental health professionals. But you've probably heard in the news that nurses are saying, why don't we consider professionals, occupational therapists, physical therapists, physician's assistants? None of that is included in this borrowing. So there's a lot of lawsuits happening. There's things changing potentially. So stay tuned. Things may change with this. Change of administration could also change some of this as well. Who knows? But as it stands today, these are the only students. So someone going into graduate school this fall is going to have some limited options when it comes to borrowing to pay for the total cost of the education. Just wanted to touch base on some other federal loan changes. So loan proration, it's a big one for colleges and maybe big for students as well. So if students are what colleges are now required to do is prorate the amount in direct proportion to that percentage of that full-time status that that student is enrolled. So to break it down into plain English, you have basically a student that's going to school, they're taking 12 credits, which is considered full-time. Let's say in the spring semester, they drop to 9 credits. So they drop to 9 credits. They're still considered over half time. They should still be able to borrow the full amount of their federal loan, that $2,750 for that spring term, right, out of that $5,500. Now the school's saying, nope, you can't, or the government's saying, no, you can't. You have to reduce that loan, not $2,750. Now it's $2,000, let's say. And so even though the school may cost just as much because they're taking whatever the credits they are, they have to reduce the loan based on the credits that they're taking. So it's becoming a mess for schools. They're still trying to figure out a lot of the terms and circumstances with that. So, hopefully that doesn't happen to your student, but if it does, just, bear with the schools as they're trying to figure this all out. Deferments are going to be reduced. So starting next July, not this July, and not less than a month from now, but in 2027, federal loans, new federal loans, are not going to qualify for any unemployment or economic hardship deferments. So those, it's another big deferment reduction. So basically, students are unable to pause some of this stuff around that. And then there's also some new forbearance limits. Basically, there's going to be some caps on durations of forbearance. So basically, a lot of students were putting themselves in a forbearance over and over and over again and not paying the loans back. This administration really wants students to start paying their loans. So they're reducing some of those forbearance options for families and students so they can start paying those loans back sooner. All right, legacy borrowing. So how legacy borrowing works is if a student is currently in college and basically taking these loans out, they're allowing students to basically teach out or finish out their program using the existing loan parameters. So for GradPlus, if they're currently in graduate school, they basically have 3 years or until their program ends, whichever comes first. So if their program's done in a year and a half, that's the amount of time they have to borrow Grad Plus and all that stuff using the same terms and conditions that they did before. Same limits and all that type of stuff. Parent Plus, same thing. They could borrow up to their cost of attendance. They don't have to fall into that $20,000 cap if they have a student who's currently in school and they can continue to borrow under those existing parameters. Same thing with the grad professional unsubsidized loans. They're not limited to that $100,000, that $200,000 cap. Basically, they're allowing students in existing programs. Now, the change to that that you want to be aware of is that any new loans borrowed are falling under the new repayment plans, which I believe I'm going to get into later in the presentation. So even though some of those things don't change as far as the aggregate limits and the amounts you can borrow, repayment programs will change because any new loan you borrow starting now, you're only going to be eligible for the two new repayment programs. I just wanted to review the federal student loan interest rates. So that was asked earlier. So 652 is your unsubsidized and subsidized loan amount interest rates for this upcoming year. Just wanted to provide some historical perspective as well. So the past 5 years of interest rates. So in 22-23, they were 4.99, so just under 5. As you can see, they've crept up, dipped a little last year and back up again. So they've been consistently in this 5 to 6 range for the past 5 years. So just wanted to give you a historical context of where these rates are going. Could they go down next year? Absolutely. The rates are based on the 99-day T-bill set in May. So that was set in May to go into effect July 1st. And that interest rate is fixed for the entire life of the loan. That cannot change. So when a student borrows a federal loan for this fall at 6.52%, that is the interest rate they're going to pay on that loan until they pay it off. And whether you finance it, consolidate, whatever it may be, but that loan will stay at 6.52 for the life of the loan. Graduate students, those unsubsidized loans are 8.07%. As you can see, the historical trend there as well. And then, as I mentioned, Parent Plus, Grad Plus will be coming in at 9.07%. And looking at the historical there, going from 7.5 up to 9 over the past 5 years. All right, I'll take a little bit of a pause and see if there's any questions that came through here.
Jeff, there's a question about the whether two parents can take out the Parent Plus loan. Maybe you could just clarify that.
Yeah, the answer is yes. So you can. It's $20,000 per student, and that's the cap that it is, regardless of the parent.
Right.
So that is I know that there are. Well, I know with like parent separated situations. If each parent could take it out. But I believe that's with these new rules, unlimited
It's
before.
still the cap.
Still the cap. So the
Yeah.
cap it's a per student cap, not a per parent cap. So a parent can borrow $65,000 in total for each student. But there is a $20,000 cap per student to borrow for that plus. So I believe I'm correct on that. Crystal, if you want to double check on that and correct me on that, but I'm pretty sure that's the case.
And this question always comes out a lot. I don't know if anybody asked it yet, related to Parent Plus and the parents taking it out. What if one parent did the FAFSA, but the other parent wants to actually take out the Parent Plus loan?
So the parent has to be on, that's a good question. I think the parent has to do that FAFSA because to be eligible to apply for it, the student is the beneficiary of the loan. So obviously they have to apply for the FAFSA, but the parent has to apply for the FAFSA to be eligible for, they'll look and see if the FAFSA has been filed before you can apply for that plus loan.
Jeff, I
So
don't
that
think, can you hear me,
oh,
Jeff?
oh, okay, Crystal, thank you.
Sorry, I wasn't going to chime in, but I decided to.
Please.
So
She's our
I,
resident expert, so I'm going to let her chat.
well, maybe I was going to double check myself because it's been a minute, but I'm pretty sure that um the other parent, actually, I know they can. The other parent can apply. So like I'm thinking of like a divorced
Right,
household.
right.
And like if mom is on the FAFSA, dad could actually go out and apply
They
for a
just they
plus
just need
loan.
to obviously set up the FSA ID, but they might not have had
Correct.
they
And
might
they
not have
just
been the parent who did the FAFSA.
right. So it is allowed. They the aid office might verify parent that individual is a parent or whatnot, but I'm in divorce situations is what comes to mind for me.
Okay. And I guess in my head I was confusing, of course, setting up an FSA ID because you do have to apply for the loan through the
Right.
federal portal. So you do have to at least start that process. So without actually putting your financial information to fill out the FAFSA, you do have to at least create an account, get an FSA ID, apply through the federal portal on that loan. But yes, thank you. That makes a whole lot of sense that, the FAFSA is really the student related essentially to make them eligible for the plus because they filled out a FAFSA, but the parent can doesn't have to fill out the FAFSA to take out the plus loan. Thank you for clarifying, Kristen.
And just because I know I've gotten these questions a lot too, and just to kind of continue in this line, the same parent who takes out the Parent Plus 1 year doesn't have to be the one that continues to take it out. So they can switch from year to year.
That is correct. Yep,
Correct.
that is correct.
And I will put a in chat. I'm gonna do some research to make sure we're 100% correct on this because it's been a minute.
Okay. Thank you, Crystal. So as I mentioned, there are going to be two student loan repayment plans going forward. The first one is a standard plan. So right now, there is a standard plan. They call it the standard plan, but there's three variations of it. There's the standard plan, which is 10 years. You take the amount you owe, that 27,000, let's say, and you divide it by 10 years. That's what the student owes to pay their loan back. Simple, simple. They also have a graduated repayment plan, which you pay a little now and more later, gradually gets bigger. It's kind of that first income-based repayment plan. Still paying it off in 10 years. Loan cost a little higher, of course, because you're paying less interest up front. And then there was extended repayment, and that was good for loans over $30,000. So again, if someone borrowed a lot, it allowed you to extend payment out over 30 years to pay that loan back. So they've eliminated all those three standard plans and now have a new standard plan, which again is going to be a fixed payment, but now it's based on the amount you owe. So a traditional student is going to, undergraduate student, they borrow all 4 years, is going to owe about $27,000. So they're actually going to fit in that second tier of less than 50,000, but not less than 25 of a 15-year repayment. So they're going to automatically go from a 10 to a 15-year repayment in the normal standard plan. As those increments go up, if you owe more than 100,000, you have 20 years over, I'm sorry, 50 and 100, 20 years, over 125 years. And that is the assigned payment plan out of the gate for students. And there's no flexibility on that. The amount you owe is the amount you pay it back. Now you can pay it off early, of course. But those are the number of years that you're going to have to pay those loans back. So a very simple plan, slightly modified from the existing standard plan. But that's going to be what students are looking forward to. Now, as I mentioned, any new borrowing done this year. So if a college student is a junior in college and they borrowed 3 years and they have their existing payment plan that they were going to sign up for, if they borrow a loan for their senior year, they can no longer use any existing payment plan and they must use one of these two plans. So that's just something to consider. You know, when I did exit counseling sessions with students leaving school this year, and I'm like, if you're not borrowing again, you can use the existing plans. If you're planning on borrowing again in the future, all those existing plans that you had are gone, and you have to use one of these two new ones. So it's a little bit rare for usually these federal regulations don't mess with existing things, but in this case, they're saying anything new going forward is going to be part of these two new plans. And the second is a RAP plan. The RAP, not RAP, it's a repayment assistance plan. So this is the new plan. It's the income-based plan. There's so the good way is they consolidated the 5 or so income-based repayment plans that were out there. Save, ICR, pay as you earn, repay, RE, revised pay as you earn. There are all these different income-based plans that were out there. So instead of, and they did a terrible job of like consolidating them. They just kept adding a new one. They put a tweak on it and make it a new one as opposed to sunsetting old ones. So this kind of goes to the extreme and sunsets them all by 2028, except for income-based repayment, which is the only existing repayment plan that's going to remain for existing borrowers that are in that are done with school essentially and done with borrowing. The repayment assistance plan is basically what the difference is on our current income-based plans is the payments are going to be calculated on adjusted gross income. So current income repayment plans are based on discretionary income. So basically they factor in your cost of your housing, your food, your cost to live essentially. And that's what they base your monthly payments on. And it could be a $0 a month payment. With this new one, it is a $10 minimum payment a month, and it's based on AGI. So your AGI could be higher than, and likely will be higher than the payment that's counted with your food and everything else. So those are again a little bit less forgiving, I guess, or less beneficial for this income-based plan. Loans are forgiven after 30 years, and as I mentioned, it's not available for Parent Plus like the old income-based plans were available for Parent Plus. So. Yeah, it's exciting stuff for new borrowers that are going to have to navigate this again when they leave school. All right, I've exhausted federal loans and I've talked for almost an hour on that now. So let's jump over to private loans. I see questions have been answered in here. Fast and Furious, thank you, Jess and Crystal, on that. The private student loans are basically same as federal. They're funds that must be repaid with interest. There are repayment and certain deferment options. They vary greatly based on the lender that you choose. Applying with a cosigner, for a student and having a cosigner attached could increase the borrower's chance for approval and potentially lower the interest rate as well. And some lenders do offer a parent version like the Plus loan, the Parent Plus loan. Some private lenders offer a parent version of that as well. So for parents that don't want their students to have any debt, that's why they take out a Plus loan sometimes. They can do the same thing on the private side and borrow a parent loan for their students. They don't have any debt. The interest rate, as I mentioned, the interest rate for federal loans, both for the Plus, both for undergraduate, graduate loans, they remain fixed for the life of the loan. You can have that option in the private market as well. Private lenders have fixed and variable rate options. And I will tell you that really no one is taking a variable rate this year. I mean, maybe 2% of all borrowers are taking a variable rate loan at this time because of the rates being so high. So fixed generally is the option. So we do mirror the federal program on our private loans. Providing a little overview of all things private lending. So as a student, what the attractiveness of a private loan is for a lot of families is that the student can be the primary borrower. So as I mentioned on the federal loan program, the student can take out their federal student loan, which they absolutely should take if they're offered it on the financial aid offer. But that again is limited in the amount, $5,500 their first year. Plus loan, the parent could take out way more than that to pay the bill. So while a private loan comes into play is that the student and the parent now have kind of a shared obligation to this loan. So the cosigner may be required. It's not necessary if the borrower has decent credit and income, they may be able to borrow the loan on their own. But as we know, most students, especially undergraduate students, don't have either one, either a good enough credit score or any income to speak of in which to borrow to pay. So I just want to touch base on international students. If any folks with international students on it, they will typically need a U.S.-based cosigner depending on the school that they go to. So that's just something I wanted to highlight that. Again, if a parent decides to borrow for the student, again, no student indebtedness, student has no obligation to the loan. Some options for parent loans are lower than the federal loans. You saw that 9.07% interest rate. That's high, I think. So you could probably do better in the private market if you have decent credit. So something to explore. There's different rates and fees and terms, and they are based on your credit, income, the cosigner that you used. Again, two types of interest rates: fixed with that same interest rate and monthly payment every month, and then variable, which does vary based on SOFR. Most lenders use that, the secured overnight financing rate. That's set, and then the variable interest rate is based on that, and it usually resets every month. Fees. So as I mentioned, those fees that the federal loans have, the 1% for the undergraduate grad loans and the 4% for the Parent Plus loan and the Grad Plus loan, typically, and I mean, I haven't seen one in years, that private lenders do not have origination, disbursement, or prepayment fees. So no fees generally associated with any private student lender. So again, that becomes an attractive option as well. And then the terms vary by lender. So as you said, you see those two new repayment programs. Private lenders will offer repayment terms anywhere from 5 to 20 years, maybe even longer, depending on how much you take out. So every lender is going to be a little bit different. The repayment options, we offer three, and most schools offer around the same. Most lenders, I mean, offer around the same. They might throw one in with like, you pay $50 a month or something, but most are going to have an immediate repayment, which means principal and interest. Interest only, which tends to be the most popular option, where you're, again, paying interest while you're in school, similar to what I recommend on the unsubsidized federal loans. And then deferred payments. If you can't make payments while in school, totally fine. Every lender offers a deferred payment option. And then repayment begins, one similar to the federal program, usually begins 6 months after graduation. Some lenders have a 9-month period in which to pay back, but most private lenders follow the federal program and do repayment starting 6 months after a student leaves school. And then loan limits. So loan limits, basically, they're typically up to that cost of attendance minus other aids. So as you saw on the new Parent Plus program, $20,000 cap, private lenders are not going to have caps on their loans. It's basically what you're able to afford, what you're able to get approved for is what you're eligible for. So if you need that full cost of attendance and your bill is $40,000, you should be able to borrow a loan for $40,000. Other features and benefits. So things you want to look for in a lender. Every lender offers different rates. They offer different benefits. So things you want to look for: cosigner release. Cosigner release is a big one. So that is where, if you're as a parent are co-signing on a student loan with the idea that your child's going to get a great education, graduate, and make $200,000 a year, and they don't need you to be on the loan anymore, so you can retire and not pay off their student loans. That's the ideal world. So what you want to look for is a lender that offers cosigner release. Most lenders have varying time periods in which a lender can be released. Recently at Citizens, we eliminated our cosigner release time period. We used to have 36 months of on-time payments before a cosigner could apply. We've put that down to 0. So as soon as a student graduates, cosigner can apply to be released for a loan. Now, will they be released? Maybe not, depending on if the student has enough income to cover the debt that they have. But you can apply every year to be released. And it is an attainable benefit. It's one thing you definitely want to consider when you're looking at a lender, what their cosigner release policy is, and if you're able to get off that loan eventually before it's fully paid off. Multi-year approval. Citizens is known for this. This is really our bread and butter. We have a multi-year loan where it allows you to apply once and get approved for the entire time that a student is in school, with soft credit pulls in the future. And knowing that the loan amount is approved, you still have to choose your rate and your term each year, but it allows that peace of mind that the overall amount that you applied your first year will be multiplied by 5 essentially, and allow that student to that have their loan balance covered essentially on an annual basis. With the soft credit pull in subsequent years, it's not a hard hit to your credit. So other lenders offer this as well. It's something you want to look into. Deferment and forbearance options. What lenders are offering for whether it's hardship deferments or other things like that. Every lender offers something a little bit different. Those repayment options, we recently added a 7 and 12-year repayment options to our 5, 10, and 15-year because parents like options. And so we looked and a lot of families chose 7 years. They like that psychologically, or 12 years. So we wanted to make sure those are added for families to pick. No prepayment penalties. No private lenders have that. That is not a thing. It was put in regulations years ago. So if you'd like to pay off the loan early, no penalties to do so. Some lenders offer loyalty discounts, automatic payments. So Citizens, we are a bank. If you are a customer of our bank, we offer a loyalty discount of 0.25% off your interest rate. Most lenders offer an automatic payment, including the federal government discount of 0.25% as well. So 0.25% off your interest rate. Just about every lender offers that. Some lenders offer a break for good academic standing. So check the lender and see what might be a benefit that works for you. And then lastly, although a morbid discussion, student death or permanent disability forgiveness, it's important. Some lenders don't offer that. You want to make sure that if something, God forbid, happens to your student, that loan will be forgiven outright for that. So definitely look at the lenders when you're shopping around. Citizens, we do offer that, but make sure when you're looking at a lender that's something you want to consider.
Jeff, can I ask
Sure.
kind of on the similar vein, what happens if the cosigner passes away?
So the cosigner, that's a different story, on a private loan in particular, because there's two people on the loan. So if the cosigner, if something unfortunate happens to the cosigner, the loan is still in the student's name and the student will be responsible for that. Now, when it comes to a parent loan, that varies. So if you took out a Parent Plus loan, that through the federal government, that essentially will be forgiven if the parent passes away. On the private side, more than likely the loan will be forgiven. I mean, there's some lenders could go after the estate potentially of the parent, to cover the losses on that. But I would say usually a lending entity would likely forgive that loan as well. So again, just something to consider around
But
that
the
as well. But good
student would
question.
need to go find another cosigner. Is that true?
Correct at that point. Yeah.
Yeah.
So if the cosigner is no longer there, essentially, then yes, a new cosigner would be needed. Especially even on a multi-year loan, because the promissory note would have to be signed on an annual basis, and it would have to be a new
Yeah.
cosigner.
I
It was
mean,
based
these
on the
are
business.
horrible things to think about,
Absolutely.
but you have to unfortunately still know what happens.
Exactly. You always plan for the worst and hope for the best. I mean, you really
Mm-hmm.
have to at least consider those options, as you said.
Mm-hmm. Mm-hmm.
All right. So if you are co-signing on a loan, things you want to be aware of. So, for a borrower that has limited credit history or poor credit, no minimum income, or no income to speak of, like most students do. Most 18 to 20-year-olds don't have any means of income or enough credit score to borrow a loan on their own. So, but if you are considering doing it, make sure you consider the conditions, the benefits of the students, and the drawback to your credit. If you agree to co-sign, make sure you analyze all the options and lay down an agreement with your student that they're going to pay it off at some point. Maybe they're going to take full control of it. You're there as kind of a backstop to help them get the loan, but you're not responsible for paying it. All those types of things, and making sure you as the co-signer are monitoring those payments once they enter repayment, because again, you are equal on that loan, or you are responsible for it. At the beginning, have that talk. And there's a whole nother presentation I do about the talk. My kids have heard it for years at the dinner table, on how much you as a family are going to be able to contribute to their education. And so, how much you as a parent are be able to, and how much a student you can afford together to help pay for school. So again, have that talk. And then, who's again the financial responsibility when it goes into repayment? So are you going to help out in the back end? Are you helping them with the loan on the front end as well as helping them pay on the back end? Is the student going to be completely responsible using that cosigner release, et cetera? Be upfront and have those discussions. It shouldn't be a surprise at the end of the day when you tell your student, "Oh, you have an $80,000 in loans. I'm not helping you pay that back." And they'll be like, "What?" Or vice versa, that your student's like, "I didn't know I was supposed to pay these back. I don't have a job. You have to pay them back." So there's all sorts of things. Have those discussions, have them upfront, have a plan in place. So when you take out these loans, it's not a surprise when things come to fruition and they have to be paid back. All right, things you should look for in a private lender. So as you're shopping around and you're potentially looking at the private lending market, things you want to look for are financial stability. There's, especially with all these upcoming changes to the grad programs, we've already seen 2 or 3 new lenders come out of the blue and like, hey, we can lend you some loans. So look for loans lenders that have financial stability. It's very important. You want to be able to borrow with someone who's going to be around for a while, that have a good reputation. There's some, do searches out there, find out some lenders, maybe they don't have the best reputation around how they service students and families. Those benefits I mentioned, that last slide had a whole host of the benefits that you can look into. Now, rate's important too. Definitely shop around for rate, but just be aware of the lowest advertised rate. Every lender is going to try to be lower than the other lender. But is everyone getting that rate? Likely not. There's probably, every lender builds in a factor of those people that are getting it. It's probably 1% of all lender borrowing that they do of those people that get that rate. So, shop around. Use what's called a rate quote tool, where you're not getting your hit to your credit. Shop around for different loans. Find out what those rates are going to be. You may not get that lowest advertised rate, but you may not get a double-digit rate either, depending on which lender you go with. So definitely take advantage of that. Look at those different repayment options. Again, whether you choose interest only or a 5-year term or a 10-year term, explore those different options and see what works best for you. When you apply for a lender, and I know, we have to lay out what the rates and terms are. So you do an application with Citizens, we're laying out a 5-year deferred loan is this interest rate. A 5-year interest-only loan is this interest rate. A 10-year deferred loan is this interest rate. We list them all out based on that. And you'd be able to see, okay, I like that monthly payment. This is what I can do. And they're all laid out in plain language for you to see. So it's very, it's a relatively simple process to look and see what your obligation is going to be. Other things you want to look at, holistic relationships. And again, I mentioned that very important death and disability policy. Some other private loan tips. So if you're a student looking to school, find a creditworthy cosigner. So you can use multiple cosigners if you'd like, meaning like not on one loan, but you can try one cosigner if you get an interest rate that maybe not satisfactory. Maybe you try an interest rate with mom. So you try with mom, it's fine. You try with dad, might be better, or vice versa. My wife might have a better credit score than I do. Maybe she does. So maybe we could use her. So that is it's an option just to try to figure out and which might provide the better opportunity. Determine how much you need to borrow. So I am a big proponent of borrowing more, applying for more than you need, but borrowing borrowing only what you need. So we'll get into that a little bit later, but that's a big proponent of that, where determining what you need, and then exactly what you're going to borrow in the end. Borrow for the whole year at once if possible. You're not gaming the system if you're applying by semester. Some people think, oh, I'm just going to apply by semester. With some lenders that do hard hits to your credit each time you apply for a loan, that's just an unnecessary hard hit. Apply once for the whole year. So that bill you saw earlier, with that say was $15,500, my bill was for the year was $31,000. I'm not applying for a $15,000 loan. I'm applying for a $32,000 loan. I'm going to apply for that loan because half the loan is going to disperse in the fall. So September, that loan will disperse. That's when interest starts accruing. That other $16,000 is just sitting, waiting to be dispersed. Come January, when my daughter goes back to school, that second half of that loan will then disperse. Interest will start accruing at that point on that portion of the loan. So again, always apply for that full year if possible, because only what's dispersed to the school is what actually is accruing interest. Okay. Now I say here, in case of the multi-year loan, multi-year you can pull. It's basically you're drawing down funds as you need them to help pay for school. So there is no hard hit to your credit once you do it once on that first loan. Keep an eye on when rate quotes expire. So as I mentioned, rate quotes is something that you do when you apply to multiple lenders, and you apply with no hit to your credit. For Citizens, it's 30 days. Other lenders might be a little bit different. So if you apply, you don't have to move through at that moment. You can say, all right, I've applied here. I have 30 days to decide. And then I could go and maybe apply for a new loan after that. Or within that 30-day window, you can apply to different lenders as long as it's not applying your credit. But if you are, and these lenders do a hard hit, because not everyone does this rate quote process where it's a soft pull, if you compare your rates within a 2-week period, it will count as one hard inquiry. That's generally how credit works. Even if you were applying for a car loan or a mortgage, they know that you're shopping for the same loan type. So within a 2-week period, if you're shopping around, it generally only counts as one hard hit to your credit if you're doing that, if you're applying to multiple lenders. All right, some approval factors. So every lender is looking at different approval factors when you're applying for the loan. So credit score is big. Obviously, knowing what your credit score is. It used to be able to pay for your credit score. In some cases, you still do, but your credit card likely has it. If you sign up for Credit Karma or something like that, you know what your credit score is. Looking at your credit history. Making sure that you're paying your bills on time. Any public record items, so bankruptcies and things like that. Credit utilization ratio, how much credit are you using? Are you maxing out your credit cards? Your debt to income, how much debt do you have and how much income do you have? And what's the percentage? Generally, we like to keep that around below 30% of your debt to income. Income verification. So, if you apply and say you make $400,000 a year, we as a lender are going to ask you to verify that. We're going to have you send payroll stubs or W-2s to verify that income. And then employment history. If you are self-employed, let's say, may we require 2 years of tax returns to show that versus someone who has a regular W-2. So each lender is going to operate in a different manner as far as how they're going to approve loans. Looking at credit reporting, so what we look at credit and how it could impact an overall the cost of education. So here's just a blanket example of someone with a 660 credit score versus a 780. They're both borrowing $15,000. As you can see, the interest rate on a 660, they're getting 10.31% in this scenario, 6.96 for one with a 780. So you see that monthly payment is up almost $80 a month. And that total interest is now $10,000 more over the life of the loan in a 10-year repayment term. So you're seeing that you're basically a little over $9,000 in savings with that higher credit score. So that's why it's very important to work on credit whenever possible and identify a credit-worthy cosigner to help with that student applying for the loan. Some ways to build credit. Now, this is a big soapbox I've been standing on recently with the elimination of GradPlus. So with students that are looking to continue their education beyond. So, me personally, I've got 3 kids, 2 in college. The third one's probably going to college as well. I'm not going to be paying for graduate school. That's not my responsibility. That if you want to go to graduate school, I don't know if my kids will, but that is something I want them to take care of and do on their own. They could do that when GradPlus was available. No longer. They're probably going to need some sort of help on the private market, depending on the type of grad loan program they go into, unless they get an employer to pay for it, whatever it may be. So what I've been instructing students and saying this is things you should start to be looking for is how to build your own credit so you could take out loans on your own. Everyone can get a free credit report at annualcreditreport.com. Annualcreditreport.com is free. It's a misnomer in the title because now you can get a credit report every week. Since COVID, they did it every week. I think it's weekly. You can pull it as opposed to annual. And the 3 major credit bureaus, Equifax, Experian, and TransUnion, all report to that. And you're able to pull down your credit report and see what your credit is and all the financial history you have. Things students can do to potentially build credit on their own, get a secured credit card. That's a great first option. If a student doesn't have any credit whatsoever, getting a secured credit card is a phenomenal option. Basically, what a secured credit card is, you take your own money. So let's say you take $500 and you give it to a credit card company. And the credit card company takes your $500 and they give you a credit card. And they take your social and all that information. And then you use your own money to buy things. And then you pay off each month. And those payments that you make each month get reported to a credit bureau. And so then all of a sudden your credit starts building up because of you using your own money. There's no risk for the credit card company, and they're just reporting your good behaviors of repaying your amounts each month to a credit bureau, which then of sorts builds your credit over time. So a great way for someone to start out in doing that. Becoming an authorized user on a card. That is personally what I did for my kids. I fortunately have good credit. So I basically, when my kids were, a couple of years ago, I got credit cards for each one of them. I said, hey, can I get took my oldest credit card that I don't use all that much anymore, but I think I have my cell phone bill on it. And I said, can I get credit cards for my kids? And they said, sure. What are their names? And they said, great. And they said, we'll send them right over, Mr. Bentley. And I said, no, that's not what I want. You need their social security numbers. And so, oh, that's what you wanted me to do. Yes. So I gave them their socials. And so now my good credit, basically me paying that bill every month and that credit card being the longest, my kids now have benefited and have now built up their credit. I believe my 20-year-old has around a 770 credit score, if I'm not mistaken. So just by doing nothing, essentially, by piggybacking on my good credit. So if you have good credit and you're able to start your kids off with that, so if she does decide to go to grad school, her credit score won't be a problem. Income might be a problem, but her credit score won't be a problem when she's applying for a graduate loan if that's what she decides to do. So just something to consider, something to work on with your students to start building up their credit on their own, especially if they're planning on going to graduate school going forward. All right, looking at the private loan application process. So just wanted to give an overview of how it all works. So this is the time of year. Parents are applying, bills are coming out. You see what you owe. Okay, how do I go about it? So again, you're visiting different lenders, looking at doing what's called a rate quote. Basically, a rate quote is, again, I mentioned is that no hit to your credit, that soft pull, and allows you to find out what your interest rates may be, or you could just go ahead and submit the application and move forward with that. The lender will then make a credit decision based on your initial input of your information, and they're going to provide you all the interest rates. You'll be able to look at the options of a 5-year deferred loan. Is this interest rate, a monthly payment, so on and so forth, as I mentioned before. And you're able to see, okay, here are the loan options that I have. And then they're going to verify your income and identity. So then if you decide to move forward and actually apply for the loan after you've selected your options, that's when that hard hit to your credit is going to happen. They're going to verify all the income and all the information that you provided on that soft pull. And then if everything looks good, the loan gets approved. Now you're going to be going through a million different disclosures that we're required to provide you, which is all great because they're very upfront and explain the loan very carefully. And then you'll be able to sign your promissory note and move forward. Now, this is when the lull happens. So you could do all that today and have your loan approved within a week. And now all of a sudden you're twiddling your thumbs and waiting and saying, where's my money? So what happens next is what's called school certification. So we have gathered all this information. The loan has been approved. You're getting this loan amount. Here you go, student. You're getting $20,000. It's all ready to go to the school. The school now has to do what's called certify the loan themselves. So they have to certify that, A, that student is attending the institution, that that loan amount that you've applied for fits within their budget. And that could take a while. And with what's called batch processing now, schools like to wait to the very end and do one big batch and process all the loans at the same time. So if you apply with Loan Citizens, there's plenty of times like, well, where's the loan? Where is it at? What should I be doing anything? No, you've done everything you've done is correct. You've signed the note. Everything's ready to go. The school can now certify the loan, and they could take 2 months to certify the loan at this point. They could certify right before school starts in August. They could wait until the after ad drop period until they know it's there. But a lot of times they'll certify the loan so it shows up on your bill so you'll know that it's paid. And that's what stresses families out is that they'll look at the bill and there's no loan on there, even though they applied for a loan. It's because the school hasn't certified it yet. But once they certify the loan will show up on the student's bill. They should hopefully have a zero balance at that point, and then peace of mind, student can move in. Once the loan you also have what's called a right of rescission period, where once the school certifies a loan, where you have time to say, you know what, I don't need that loan anymore. And it's so that's last step ditch process where you could actually cancel that loan, no harm, no foul. And then, of course, the funds are dispersed to the school finally. So looking at some of those requirements again, they're going to be looking at to verify your identity, income verification. There's a self-certification form that you have to fill out as well, acknowledging those disclosures in the school certification. Those are things that are going to be required during the process. But there's a lot of could be at that first half of this grid of this chart is hurry, 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 apply. And then again, there could be months of waiting while the school certifies the loan. So know that if you've done everything you've said you've done and you want to verify it and it's in a status is awaiting school certification, you've done all you can at that point. It's up to the school to do their part. All right, looking at, just want to touch briefly on repayment options. So similar to the federal program, we do have different repayment options. There are deferment, interest only, immediate, and those happen while you're in school. And then again, those terms could be anywhere from 5 to 20 years, but I kind of already went over that, so I won't beat a dead horse with this. All right, so what happens when a student is denied? So what steps we take as a lender, what we'll do is we will send an adverse action letter that's required by law within 30 days. So it'll clearly state the reason for the denial, the sources using, so the credit bureau that we use to make that credit decision. And then if we have the ability to provide the credit score that we had at the time, we will. Some lenders have a minimum credit score requirement, so we will obviously put what the credit score was when we pulled it. And those are the steps that we take there. And then steps that you could take at that point is say, okay, well, if I'm a student and I'm denied, and most students likely will be, they'll be what's called conditionally denied, meaning they just don't have enough income or a credit score to apply, but they don't have like a bankruptcy where they're unable to apply. So they're just sort of conditionally denied, but you just don't have enough info on them. They can now add a cosigner or a different cosigner. If there's any derogatory information that's been reported incorrectly, go back to the credit bureau, have that corrected, and then reapply again. You can use that adverse letter as a tool. Get that free credit report, work to improve your credit history score, your debt to income, credit utilization, all that type of stuff. And then, of course, there are fallback options. So you could take out a private parent loan or a federal Parent Plus loan. So those are options as well. Because again, with that minimal credit check on the federal loan, just know that now where you could borrow up to the full cost, you have that $20,000 cap going forward. All right, where to research private lenders? So the best place we like to send families is start at the school's website. Most schools, and I'm not saying all, but most schools should have a lender list. And it could be a small lender list, like 4 or 5 lenders. It could be a list of 50 lenders. But every lender should have some form of list that they either do themselves or most schools use an online comparison site. The 2 major players in the comparison site world are Elm and Fast Choice. So Elm Select, you may see that on a school's website. This is what Elm Select looks like. Just provide an example. And it states clearly what the lender name is, the interest rates, the type of loan. And then when you click in it, you'll see further details on how that loan exists. Fast Choice operates the same way. School uses it to display the different lenders that they offer a particular school. There are lender marketplaces like Credible or FinAid.org. Just be cognizant of those because they're pay to play. So lenders pay to be a part of those sites. It's not a neutral site like Elm or Fast Choice. And then, of course, you could also Google, but know that that's pay to play as well. The lenders that pay to be at the top of a Google search are the ones that are going to be there on aggregate sites, on Google searches, so on and so forth. It's not a truly neutral site. And like, again, most schools take time to vet lenders or use lenders that students have used in the past. So you can trust that what the schools are providing are likely going to be reputable sources of lending. And you'll be able to do your exploration that way and pick and choose. Schools can't tell you who to borrow from, but they can provide guidance on the different types of lenders to allow you to do research in which to pick a lender that's right for you. All right, wanted to touch briefly on refinancing consolidation. So this is a future thing for most students, but federal consolidation is a federal loan program that does exist today. But it has also exists since loans have been around. And it's really unnecessary now as an option in my mind. Back in the day, as long as I've been around, banks used to do federal loans. So Citizens, Bank of America, Chase, Citibank, we all used to do federal student loans. So you could borrow a Citizens loan your freshman year, a Citibank loan your sophomore year, Wells Fargo your junior year, and then you're left with all these different loans with different lenders. What consolidation allowed you to do is combine all those loans into one, take the weighted average of all the loans, round it up 1/8%, and now you have one payment to one place to pay your loans back. Now, federal loans are assigned one servicer. There's 4 servicers out there now: Ed Financial, Mohila, Nelnet, and Aidvantage. And those are the 4 servicers. So when a student takes out a loan, they're going to be given one of those 4 servicers. And for the life of their borrowing each year, they're going to be assigned that same servicer. So again, kind of unnecessary to take the weighted average of the different loans, round it up at 8%, when you're just going to be paying one servicer anyways. You're going to be paying each loan individually, meaning as one total, your total lump sum. They'll take your whole payment and pay each loan on the back end. But it is one place you're paying. So again, I don't believe consolidation is a necessary tool currently, but it is still out there as an option. Refinancing is what private lenders do. You can combine both private and federal loans into that. But again, I always have pause with federal loans because there's a lot of protections, those different repayment options, certain forbearances and deferment options, even though some of those are going away, options with federal loans that private loans don't have. So if you are going to refinance for public service loan forgiveness, a bunch of things, just be cognizant and be aware of that if the student is going to refinance the federal loans. If they're not getting any public service loan forgiveness, they don't care. They just want to get everything under a private. They want to lower their interest rate. By all means, you can do a private loan refinance. And that is basically paying off all existing loans. It's a brand new loan with a new interest rate, and allows you to consolidate all different loans with different lenders into one area. So again, those I just wanted to touch briefly on those. It's a future thing for most students, but just something.
Well, Jeff, I get this question a lot about the Parent Plus loan, of parents asking, can they refinance the Parent Plus loan, into a private loan and then include their student on that loan?
They can. It's generally a multiple step process. So I guess I can speak for Citizens that, and other lenders that offer parent refinance loans. So if you have a Parent Plus, what you can do is refinance it as a private parent loan and then add your student as a cosigner. So basically, while they're both there, so your student's a cosigner, you are the parent on the loan, you both are on the loan, and then once that loan gets processed and funded, you can then refinance again. Now, I will tell you that refinancing is free. Do not pay anyone to refinance a federal student loan or a private student loan. It is free, free, free. And you can do it as many times as you want. So at that point, yes, you have a parent loan, a private refinance parent loan with the parent as the primary, student as a cosigner, and then you could refinance again with a regular student loan and now turning it around and making the student the primary borrower,
Right.
the parent as a cosigner. Now it becomes a traditional refinance loan with the roles reversed. Student as the
Right.
primary, parent as a cosigner.
So it's
Private
possible.
refinance
It's
have
just a few different steps.
exactly. And there's cosigner release for refinance loans. So again, that parent could eventually come off that loan under a cosigner release policy. So yes, it is a multiple step process, but it is an option for families to do.
Okay.
All right. Lastly, since I have talked for over an hour at this point, thank you for staying with us. For those that have, how we can help at Citizens. We have a great student hub. Please visit it. We launched it late last year. It's some great tools and resources around planning, paying for college. Obviously, Debbie's a great resource as well. Utilize different ones out there to utilize all the tools you can to figure out the best way to help pay for college. We have a scholarship. We award $2,500 a month and $15,000 annually in April. It's a sweepstakes. You do not need to be a customer of Citizens. Parents can apply on behalf of their students. Students can apply if they're 18 plus on their own. We always encourage. We had a student from Idaho win our April scholarship. Yes, our May scholarship. I think going to Boise State, if I'm not mistaken. So it's a sweepstakes. We encourage everyone to join citizensbank.com/scholarship or scan the QR code here. On the Student Hub, our College Raptor scholarship resources, they also have a scholarship themselves through College Raptor on our site, but they have a great scholarship search tool. Utilize that. It's free to search for scholarships because, again, free money, better than borrowing money. Private student loan options. I touch base on our multi-year loans. We do student loans and parent loans. Our multi-year approval is exactly how I stated it, is basically you apply once and we approve the amount that you are eligible for, or a student is eligible for, basically 4 years plus 5, plus another year. Yeah, some students are on the 5-year plan, or to consider cost increases of 3 to 5% on tuition each year. But it allows that peace of mind that you know that amount's approved for the total time of students in school, with soft pulls to the credit. And annually, we don't do income checks. We don't do any of that. If the credit looks fine, the loan will swim. It will basically sail through. You still need to choose a rate and a term. A private loan is an annual process. So you could do a 5-year deferred loan in year 1, a 10-year interest-only loan in year 2 with a different interest rate. But the amount has been approved on the back end. We have a loyalty discount, again, of 0.25% if you've been a customer of the Citizens. Automatic payment of 0.25 as well. We have fixed and variable interest rates, and again, no fees around application disbursement, etc. I already talked about multi-year. This more details on this. So basically, you complete that rate quote on a Citizen student loan. We'll let you know if you qualify for multi-year and how much funding you qualify for. So not just for 1 year, but for all 4 years. A pro tip I like to do with this is, again, my personal journey that I did with my daughter. I front-loaded her fall semester when she started with scholarships. I took all the scholarships she won and didn't spread them out over the year. I used it to pay for fall, and I used that tuition payment plan. So we didn't borrow it all in the fall. However, I wanted to be approved for multi-year. So in the spring, I applied for $25,000 for the spring, which got me a multi-year of over $100,000. So now I know she's covered for $100,000 in approved funds for the time that she's in school, unless my credit goes in the toilet. But did I take out $25,000? I did not. I only took out what she needed, which was $8,000. So that 25, but now I'm approved for that over 100,000, but I only took out what I actually needed, which is with the 8,000. So that is how you can use the multi-year to get approved for more. And again, I always say ask for more than you need, because the school's only going to tell you what you're eligible for and then only actually borrow and take out exactly what you need. Don't, always get approved for more, because it's easier to reduce a loan than it is to apply for more. All right, some pros and cons on federal and private loans. Some of the pros, they're the best protections for students. They offer fixed interest rates and certain borrower protections. So absolutely, students should take advantage of those on the federal student loans. Even on the plus loans on some level if you're looking for certain borrower protections. Some of those cons, they now have annual and lifetime limits, $5,500 for a federal student loan for a first-year student, $20,000 for a plus loan. So there may be a gap that needs to be filled. And then, of course, those originations fees, especially on the plus loans at that 4%, can be very onerous. Private loans, pros, so they can cover the entire cost of the education. We don't have caps on our loans. Borrow up to that cost of attendance minus financial aid. And borrowers with strong credit and or have a good cosigner can get competitive interest rates, more competitive than the federal program, I believe. And then some of the cons, well, you know what? They lack income-driven payment plans like the Fed program does and other forgiveness options that the private loan market does not offer. And then again, cosigners are legally responsible for payment of the loan if something happens to the primary borrower, meaning they not death or disability, but if they decide not to pay the loan back or default or ignore the loan, the cosigner is legally responsible for the loan. So that is something you want to consider. So it's a certain risk on that. If you are taking private loans, be aware. Be aware of that credit, what it means to be a cosigner, some of those steps I talked about earlier. Know the difference between what your family can borrow and what you should. Just because you can borrow $100,000 doesn't mean you should borrow $100,000. Again, part of that talk about what you can afford as a family. And then lastly, really focus and talk to financial aid offices. They are there to help. They answer these questions all the time. They're lovely people financially. I hung out with about 80 of them today at an event, and they're just wonderful people. So just ask them questions. They're always happy to answer any things you have about loans or how to go about the paying for college process. All right, last slide for those who stuck with me. Thanks for sticking it out. Some smart borrowing tips. So again, determine who's going to be that primary borrower. Is it going to be a parent loan where you don't want the student to have debt? Is this you want the student to have some skin in the game, which tends to be the most popular option with a parent or another relative as a cosigner? Again, apply for more than you think, but borrow only what you need. So that is always my recommendation. Always apply for more. Get approved for as much as you can. Again, the school's only going to certify what the student's eligible for. And even after that, with that cost of attendance, that budget. So let's say you apply for $50,000 and the school says, no, you're only eligible for 40. Okay. There's the $40,000 I'm eligible for. But then you look and that 40,000, the tuition, you only owe the school 28,000 for the tuition. So I'm only going to borrow 28 to pay for the bill, not to borrow. Maybe I can cover the extra cost, that 12,000 I don't need with something else. And so those things, again, borrow more because you can always reduce or just don't take it out because again, interest only accrues when the loan hits the school. So only when it disperses. If you have the ability to pay interest in school, please do. Again, that's a great option if you can, whether it's taking out a private loan, choose the interest only option, or on the unsubsidized federal loan, go in there, pay every quarter, go down and look and see what the interest is and throw $20 at it and pay it off. Use loan calculators. Every lender has ones. Use those to see what the true cost of borrowing is going to be, whether it's on the federal studentaid.gov has a loan calculator for the federal loans, private lenders do as well, and understand what that monthly payment's going to be, what the overall cost of the loan is going to be with interest. Use a good calculator to be able to understand, you're not just borrowing for 1 year. Remember, you got to factor out multiple years and multiple children. Again, I've got 3. I'm already going to be dealing with 2 in college next year. And then one's coming up. He's a freshman. He'll be there, after my other one's gone. But that's going to be, some factors I have to consider. And then lastly, what we encourage students to do is they're borrowing and they're looking, one of the, sort of the overall tips that people say is try to keep the total borrowing below what a potential starting salary would be. So if a student's leaving school with a $60,000 salary, maybe they're going to be a teacher, it's wise to keep your borrowing below that amount. Sort of just a general rule of thumb around borrowing costs. So I'll leave you with that. I see Jess and Crystal have been answering a host of questions in the chat. Thank you both. I am going to pause and take a look and see if there's anything that needs to be answered live. Crystal, Jess, please keep me and Debbie if there's anything I need to answer live.
The only thing that came up a few times, and the parents that have twins, do you have any advice about how they deal with taking out loans?
Friends of mine have twins, and I'll be advising them in a few years. But it's my freshman son, so they got a little bit of ways to go. But it's going to be that's one where it may be worth it to try use a different cosigner for each one. You always have the fallback of parent loans. There are some of talk now of maybe exploring the private market first in some ways because there are no caps, and you can always fall back on a parent plus loan, even though that $20,000 is there to maybe backfill if your debt to income becomes too high, et cetera. But it's going to be one of those things where you're going to have to cobble it together. As I said, there's no one easy way to pay for college. Use savings, use a payment plan, use loans. Maybe you use a plus loan for one twin and use a private loan for another. There's definitely options for both. And again, have that conversation with the students, with your children, to discuss like, okay, how's this all going to work? Maybe one's at a lower cost school than the other. Maybe one got more scholarships than the other. Hopefully that's the case and you're able to just, kind of cobble it together. But I mean, it is certainly an option to use. You can use the same cosigner for both. But obviously that just doubles the debt to income along those lines. So maybe it's a case where hopefully you can use, and again, it doesn't have to be a parent. It could be any relative can be a cosigner on a loan.
And do you mind just explaining that one piece? Because I know we talked about it, like, several weeks ago, and I think it's worth um, parents understanding the idea of maybe using private loans first because of the whole debt to income ratio,
Yeah.
how that might
So
build up.
yeah, exactly. So a lot of schools for years have been, I wouldn't say pushing, but basically saying you should be exhausting all federal loans options first. Now, we in the private industry haven't always agreed with that. Federal student loans, yes, students should take the loans that are offered on the FAFSA, on their award offer, like on their offer letter. Absolutely, they should take the federal student loans. Federal parent loans, that's where I think that some schools, again, as I mentioned before, used to put it on the bill and you'd have a zero balance. Like, oh, I have a zero. What do I do? Oh, I just click here and I go, okay, now I have a $30,000 loan. And that's probably not the best way to do it, but it's easy for the school. They've got the bill paid. They don't care. But not maybe for the parent. But it's a very easy loan to get. Easy credit-wise, easy to click and apply and sign and get the loan. Like it's done. It's not difficult. So some parents just want easy. They don't want to deal with it. If they took the time to maybe explore the private market, they would maybe get a better interest rate. Not saying they will, but they could get a better interest rate, better terms, but not that 4% fee off the top. Again, it takes a little bit more work, but they may have a better option if they're planning on doing that parent route as opposed to a student route. But when it comes to why am I blank on the question you asked?
About the debt to income
Yes,
ratio and
yeah.
kind of,
So
yeah.
yeah, so with the new terms, with plus loans being the be all end all, they used to be you could borrow whatever you needed. Now with that $20,000 limit, the mindset's kind of shifting. Well, maybe explore the private market first, borrow what you can up to that cost of it. Because again, if you borrowed a plus loan, if you borrowed $40,000 a year in a plus loan, and so whatever it is, $160,000 in a plus loan, which some families have done, the government's not checking whether you can pay that back or not. There's no debt to income. But on the private side, we are looking at that. If you borrowed $160,000, we may look and be like, oh, that's, by the time you get to junior year, maybe like your income can't sustain what you're borrowing. And so at that point, you can turn to the plus market. Now again, it's $20,000 per year, and not you can't take the $20,000 you didn't borrow in freshman sophomore year and apply that to a junior year. It is that $20,000, but with that 65 aggregate. But it does sort of allow you to explore the private market first, potentially knowing that the plus loan is there as a backstop if you need it. So that's just a different way of thinking at it, where it's always been federal, 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 federal. Now it's like, okay, maybe explore private first and then use federal as a backstop on the plus side to cover any outstanding remaining balance you may have.
So I wish that, people could walk away from this and kind of like feel that it's simple. It's unfortunately, not going to be as simple as we would like. And I think particularly everything that we learned tonight and what you just said, Jeff, what to me is also so important is for families to try and look at 4 years of how the payments and the paying and the borrowing is going to work, not just
Absolutely.
1 year, because because the worst situation, and we really want people to avoid this, is that you get to the point of, junior or senior year and all your options, you've run out of your options because it wasn't planned properly.
Absolutely. Yeah. It's really is, it's planning for that. Maybe you don't, if you have 529 money, you don't use it up front, or you try to spread that out, but again, having that talk and having that plan in place, not what you can afford this year. Because I know plenty, college tends to be an emotional decision for students and they have to go here. And the family's like, I don't want to disappoint little Johnny, little Susie. And I want to make sure that they, get the college that they want to go to. But having that realistic discussion of how much it's going to cost, you don't want, again, it's almost worse pulling the rug out later. Now, there, of course, there's things students can do. They can lower the cost. My daughter became an RA. That immediately shaved off 80% of her housing and food her sophomore year. It's going to be 100% junior and senior year. So that's great for dad. Dad loves that. That's less we're paying for school. And so she knew that going in because, again, she's heard me talk about it for years about things students can do to mitigate the cost of college. Applying for scholarships. You can apply for scholarships, not just done. You're not done your senior year. A lot of scholarships are available all the way through school. My colleague Gina, who I presented with last week, she worked at a college in Rhode Island, and she had this female construction scholarship. She couldn't get anybody to apply. She couldn't get anybody to apply for this particular scholarship. So this scholarship that the colleges have that sometimes they just can't get anybody to apply for. So always have the students explore for that. Again, free money, free money, free money. Maximize it as much as possible. And so it really is a way to kind of use all those resources, whether it's free money, whether it's using the private market, using the federal market to put together a plan of attack that's not just for 1 year, but for the entire college payment options.
Well, this was a ton of information, Jeff. I know you got to rest your voice because you've shared a lot. One last thing, and somebody's asking, this is where can people continue to get help or questions answered through citizens beyond tonight?
Yeah, we'll put in, I guess I'm not the fastest typer, but I'm going to put in college-bound citizens am I typing this correctly? I probably am not because I'm a terrible typer. Citizensbank.com. And that's Citizens Bank, college-bound citizens. Oh, see, forgot the S. Boom. College Bond Citizens at citizensbank.com is our email address for our team that we go out to, in our mainly we're an East Coast bank, but we go out and we do sessions all over the country, sometimes at schools and virtual sessions, in-person sessions, to explain this process, to talk to families about how to pay for school.
Can somebody go into a branch if they're near a
Absolutely,
citizen's
yeah.
branch?
100%. Jess, again, Jess is on my team. She's our branch liaison. She's out there every day. She was at Penn State earlier this week, training the Penn State branch on how to talk about student loans. So yeah, our whole team is usually out there helping our bankers talk about this. But they can absolutely, if they're in this area and they're near a Citizens Bank branch, they're happily can go in and speak with the banker and talk about the lending that we offer and some of this college process. Absolutely. Yeah. So, Debbie, thank you again. This is always wonderful. Again, I talk forever on this, and it's a lot of information.
There's a lot
Thanks
this
to
year
those,
more than ever. Yeah.
yeah. Thanks to those who stuck around, and heard me out. And Crystal and Jess, thank you so much for answering the chat. I didn't really even look at the questions because of knowing that the two of you were
They did a great job.
have been firing away in there. That's great. I'd love to see some of the questions after the fact, if that's possible, just to see what was asked. That would be
And
great.
you have a long-term customer who just wrote, they said,
Oh,
I've been banking with Citizens for 29 years.
oh, that's wonderful. Thank you. That's great to hear. And hopefully you knew that we had student loans because that's our mission. Is while we do all sorts of banking, we always are out there, willing to share that we also do student lending as well. So it's a crazy time upcoming. It really is.
It is.
So good luck to you, your families, your students, whether you're starting this fall or you're currently in high school and you're thinking about the upcoming years. Like, it's really going to be a whole new world for both the colleges that we're working with. They're still dealing with new regulations and rules, and the families themselves trying to decipher all this. So we'll do our best to keep up on this and let you know everything. But Debbie's a great resource as well. Please use Road to College. Continue to, we'll be continuing doing these webinars throughout the year to help answer these questions. So thanks again, everyone. Debbie, I'll leave you with the final words to send everybody off into the night.
Thank you, Jeff. Thank you, Jess. Thank you, Crystal. Thank you, Citizens. There's just so much changing that we really appreciate your expertise and bringing this information, and honestly just being here to answer questions because it's a lot to absorb, and then of course you relate it to your own personal situation, and then you realize, oh, I have these questions. So you will get the link to this recording, listen to it again, and as you come up with new questions, we will put the link that Jeff shared in the email as well. So you have a place to reach out at Citizens to get your questions answered. And also, yeah, if you're near a branch, walk in because that's a nice way to get some of this information person to person. So thank you, everyone. Good night.
Absolutely.
Next few weeks are going to be a lot, but reach out with questions and hopefully we'll be able to get you answers.
Yep.
Okay.
Great.
Thank you.
Thanks, everyone. Take care.
Good night.